Hello, everybody. I want to welcome you to the All-Star Financial Quarterly Review, first quarter 2016 webinar entitled Uncertainties Keep Markets in Flux. I'm Bob Klefsaas, president of All-Star Financial. One of the first things that we talk about is kind of a Bob's Corner. We felt it was really important that you know that we are moving. We've been 25 years here at Northland Plaza. This will be our fifth build out here. We're not moving buildings at all. We're just moving from the 14th floor to the 6th floor with 30% more space because we are growing. So again, thank you for that. When we look at the market overview, we're looking at really the reason behind the volatility is four basic reasons. Number one would be China and its slowdown. We've seen the second largest economy in the world with 33% of our growth engine cool down by about 50%. Government efforts to really curb currency and market volatility didn't work. So we saw some uncertainties there where we saw the Chinese market drop 16% to mid-February. It ended up down only about 5%, but that was a big uncertainty. The oil glut continues to be an uncertainty in what the Arab nations are doing with that and what we're doing and how it's affecting our production of oil. Central banks continue to intervene overseas. We've basically been a contrary move where everybody else is easing, and we have raised interest rates now in November of last year. Again, that was a concern for the economy and uncertainty for the markets. And then the political question. For the first time in my career, we have some geopolitical concerns where the way people are looking at us. Who's going to be the new administration and the uncertainties surrounding there. The economy is a big important, obviously, aspect of what we do and what we read the economy doing. We still look at economic growth in Japan and Europe with deflationary risks. China has, as we said, slowed down from about 12% GDP growth to 6% in the last 10 years. A 30-year engine is not performing at 50%. That obviously slows the economies around the world down. Central banks, as we talked about, they remain diligent in their lowering of interest rates in Europe and around the world. We started to raise our interest rates. Probably not a good bet that we should have done that. And we really have a modest pace for our growth here, and it's a cautionary tale because we've been with this modest pace now for almost 30 months. We're seeing unemployment down. Guys, I don't believe the numbers. I don't think it's 4.9%. I think they're measuring it differently, and I've got a lot of people that say the same thing. Personal spending's up a bit, not as much as it needs to be, where personal savings and paying off credit cards are doing better. Business investment, minus 2% in the fourth quarter. We need them to pick up their spending habits. Industrial production obviously down a little bit. That's not as big a concern economically as it once was. The economy looking forward, however, we can still say that the consumer is going to drive the results, and that's by buying and making those decisions. Even with the oil dividend, they're not buying enough. So we have continued caution again on the consumer and business side. The business side, as we saw, shrunk by 2% in the fourth quarter. Inflation's really not a big concern, which is a very, very good thing. We got core inflation at 2.3. Without some of the energy and medical, it's only about 1%. And the interest rate uncertainty, I think, the one and done is our philosophy. I think they probably raised interest rates at the wrong time, and the additional raises that they are talking about today, I think, are not going to transpire. The bond market basically reeled with the decision of the interest rates to go up, basically in a positive, which we thought would probably be negative. The interest rates actually fell 35 basis points, and basically what the consumers are saying is interest rates need to be lower than higher. People went from the uncertainty in the stock market and put a lot of money into bonds. That demand for bonds lowered interest rates 35 basis points. We saw emerging markets go up, global markets go up significantly. Our high yields inflationary protected bonds in the U.S. go up. So again, a very, very positive scenario. Our bond portfolios in the emerging market core bonds, the floating rate, low duration, they all did well. So again, it was a good quarter for interest rates and bonds in particular. So looking forward, what we believe to be the Fed's going to have to hold on the short side of the interest rate cycle could help maintain some stability in bonds. I'm not sure we're going to see as good of a total return as we've just seen. High yields in emerging markets probably appear to be the most attractive. And again, the oil supply and the demand as it reverts to the norm will probably have a good effect on high yield bonds. When we talk about the stock market, domestic stocks really took that big sell-off. We saw a slide in the third quarter, a rebound in the fourth quarter of 2015. We saw a slide in the first half of the first quarter of 2016 and a rebound almost right back. So these two big V's have created really a sideways market, and a lot of uncertainty is still out there, and that's the reason why we're seeing that. Large cap stocks perform probably the best with the Russell 1000 at a positive 1.2. Small caps underperformed at negative 1.5. Consumer staples and materials performed probably the best. Worst scenarios were basically pharmaceuticals and some of the healthcare situations based on the fear of some of the reforms going on there. And obviously the corporate earnings, S&P 500 companies showing a 4% decline in the fourth quarter. So looking forward for domestic stocks, there's more slow growth on the horizon. I think corporate profits, as we've talked, are muted. If we can grow at least 2% the rest of the year, I think that would be great. Consumer spending obviously is going to drive the economy. Go out and spend. You're spending on healthcare, you're spending on financials, technology sectors. We think that the recovery in the energy sector would be a helpful part to happen. But right now, because all of these four issues haven't really been settled, we believe cash is king for now. And even though the markets have bounced twice since we sold in 12/30, we sold about 10 to 12% of your portfolio. We believe that again the markets are have some downside risk. Cash is king right now, so we've got a lot of it for you. International stocks, on the other hand, are still lagging the U.S. We saw the drop in the U.S. We saw the drop internationally. Europe dropped about 3%. Japan about 7%. They didn't quite recover quite as fast as us, so they still remained negative for the quarter. China was down, as we talked about, 16. It came back about 11%, so it was only down 5 with their continued transition from a manufacturing to a service and consumer-driven economy. Emerging markets of Brazil, Venezuela, and Russia, the three that have the worst records as far as management and political concerns and inflation, were the best performers. Would not have guessed that to happen. We bet on China, and China didn't perform as well. So our emerging market exposure was hurt a little bit there too. Internationals going forward, however, we still expect further stimulus to continue in Europe and Japan, maintain their aggressive monetary policy even with negative interest rates over there. And the foreign markets again are very, very attractive, where we look at low valuations relative to their long-term growth and more favorable than the U.S. stock market by far. So as summary, when you look at the first quarter, we saw that early meltdown to the first 6 weeks. Our cash position was really, really good. The market was down 10 to 12. Most of our clients were down about 5. We saw this big bounce back up, so everything ended. I think the Russell 3000 was down or positive, just very, very marginally. But we still have the contributing factors there, and those uncertainties are China, oil, interest rates, and politics. One of the things that we like to talk about, however, is that our nomiker is it's not how much you make, it's how much you keep. We have seen more volatility in the last 6 months than we've seen since 2007 and 2008. From August 14th to February 12th, of this past year. We saw markets decline hugely, somewhere between -9 to -15, 18%. -9 for the All-Star Financial Composite, 9.2, outperformed all of those indices. On the bounce back, we didn't perform quite as well as most of them, but we performed at 8.1 to make us in that full range, the second best performing asset class relative to the Russell 3000 being the best. That entire range, we were only down 3.2%. The Russell 3000 was down 2.8. Europe down over 10. Emerging markets down 3.6, and the global BMI down 5.5. Picture means 1,000 words to a lot of people, and these are the All-Star Financial performance on the green line relative to the other indices. You can see that we are second in the race as performance relative to the Russell 3000, outperforming us a little bit. The green line is right below the purple. So we feel really good about the outperformance. We didn't do as well on the upside, which we promised, but you see that green line a lot less volatile on the downside, which is exactly what's going to get you more money in your bucket. Just for fun, we have a page here that we talk about. The restaurant we chose is Tavern en France. Don't live too far from that. You can make your own pizza, make your own salad, make your own sandwiches. They're just burgers. They're just fantastic people. Now with the weather getting better too, they have a great patio outside. John Shevlin gave us a great recipe on his easy grilled pork chops. Got some honey in it that you'll appreciate and like. And the quote for the quarter, I think, is really great, coming from a man that's very, very wise, Warren Buffett. Price is what you pay, value is what you get. Very similar to us in the investment side. So again, I want to thank everybody who's continued to have the trust in the All-Star Financial team in managing your assets. If you're a potential client, I would welcome you to call us with any questions. Our clients have the ability to reduce their fees by referrals. So again, thank you, clients, for doing that. And last but not least, we want to make sure that you understand that we're here to service you. We're a service business. Our high net worth clients, we would like to make sure that your every need is met, and our 9 teammates are here to serve you. So want to really appreciate or thank you and let you know that we appreciate your confidence in All-Star Financial and look forward to talking to you soon.